Okay, we are live. Welcome to Boston Basic Income. I'm Alex Howlett. This week's topic is the gold standard. So most of the advanced world's currencies were backed by gold. They were convertible into a certain amount of gold in the late 19th century, early 20th century. So a question we can ask is, why did that happen? Why did everyone kind of coordinate on gold as being the basis for um, international standard currency? And why isn't it that way anymore? And we can also ask, in a gold standard world, is something like a basic income doable? Or does that depend on us moving away from gold? So what are the advantages to gold that cause it to be the basis of all of our money? And then what are potentially the disadvantages or the causes of us having to move away from that standard? So I want to go around and get people's initial thoughts. We'll start with Eddie, and then Neil, and then Richard. Go ahead, Eddie.
So I'm glad we're doing this on the topic of the gold standard. It's really interesting, and uh, to talk about the question, I think gold was you can compare gold almost a little bit to private money in a world that does not have a world government, and so within a country, you can have a national currency that the national government takes care of, but between countries, because you don't have a world government issuing a world currency, then the different countries would have to trade through gold in the past. But I think it's particularly interesting, the article that we read. A lot of these gold bugs, they subscribe to something called Austrian economics, and the Austrian perspective, which I won't try to get into too much introduction, but it has certain aspects of it which are very relevant and very interesting. But yeah, I think that would be too long for the intro. So let's let other people talk first.
Okay, let's go to Neil, and then Richard, and then Bethany. Go ahead, Neil.
Gold was originally used as a medium of exchange because, first of all, in history, historically, it doesn't oxidize with any other easily with any other uh, elements. So therefore, or combined. So therefore, it could be pure, and people would believe it. And secondly, it was thought to be scarce. So you would have just enough gold to cover transactions. And so that's basically the reason I think people accidentally they use gold and sometimes silver for the same similar reasons for as the local currency of choice. And then when the world became bigger, obviously, as Eddie just pointed out, we had to have a way of transferring money between countries. So people naturally just took up on the gold standard, which and actually some of the time it was silver too. And that is my perspective. And I basically think a gold standard is terrible because because if you have a gold standard, then economic contractions are really going to. They used to have every 10 years they would have a massive economic crisis because of the fact that the money supply was limited. So and as you know, some people obviously are appalled by the fact that we can just create money out of thin air. But by doing that, we are able to if we do it properly, big if we can make the wheels of the economy grow much better. In fact, that they have, of course, as pointed out, as found out, we can get carried away, but we had a period of longest period of non of things. Great moderation. We had a great moderation for 30 years when nothing really terrible happened. And it's not with gold that it was every 10 years, almost like clockwork. So that's what my commentary.
Okay, yeah. So it's an interesting question. Did we adopt gold as money? I guess a certain part of it, as Neil is pointing out, is that it had certain physical properties that made it something that was fairly consistently valued in the market. People generally valued gold, or there was somewhere where you could sell gold, so it kind of became this commodity that could be traded for anything, and then kind of turned into money through that mechanism. But then the question is, if it's a terrible standard, why did we have it? Maybe it was better than the alternatives back then. And I should say that that Eddie mentioned the article that we read. We read an article from 2019 from Quartz entitled "The Quiet Campaign to Reinstate the Gold Standard is Getting Louder" by Natasha Frost and Gwynn Guilford. So this is actually something that's part of the discussion right now, and it's partly related to the fact that one of Trump's recent nominees for the Federal Reserve Board is this woman by the name of Judy Shelton, who believes in a gold standard. And right now, it's looking kind of iffy as to whether she'll be confirmed, but it's in the conversation right now, and it's always kind of been lingering there as well. So let's go to Richard. Go ahead, Richard.
Well, we still have, recessions and things every 10 years. Like in 1980, the early 80s with the Volcker shock, which they mentioned in the article. Then in the early 90s with right after the Desert Storm, there was a mistaken recession, then the dot-com recession like 2001, and then 2009 we had the Great Recession, as they call it, and then right about now there's going to be another one with COVID recession, and so that still happens. Well, back to 1879 when the gold standard was introduced, that it was said that in the article that they allowed for great investment in the countries, and so they allowed them to boost up and rather quickly over like a 40-year period or whatever. And I don't think that a basic income could occur underneath a gold standard, because it wouldn't be able to expand the amount of money available each year sufficiently. And I don't really know how people would how do I say it? How we would be able to adapt to it quickly enough.
Yeah, that makes sense. If you're giving everybody new money every year, how does that? How can you really do that if the amount of money you can give is limited by something like a gold standard? And I like that you brought up the problem of economic stability and financial sector stability, and how we still have problems with that even without a gold standard. We have problems with a gold standard and without a gold standard. So the question is, how do we prevent that? And is it perhaps not? Is having a stable currency or a properly functioning currency standard not enough, maybe, to prevent these kinds of repeated recessions? So go ahead, Bethany.
Yeah, great. So I agree with some of the pros that Neil brought up in terms of why it was ever used in the first place. Like, you need something that to bootstrap any kind of currency, you need something maybe that people already think is valuable to base it on or to back it with. And so, free floating currencies would be based on the gold standard for quite some time. Maybe there was a time when people only literally traded in gold too. I'm not sure about that history, but anyway, I think that it also has the limitations that people have talked about. I'm sure you're going to get to this, Alex, but the currency needs to be, you want it to be stable with respect to like things that we actually buy, so that there's like a stable meaning to the currency. But if it's also being backed by something like gold, it also needs to be stable with respect to the gold, for example. And so that's like two goals instead of one. And so presumably you have to kind of toggle between them, and it's difficult and more difficult to achieve the goals that you want to achieve. In terms of whether you could have a basic income with a gold standard, I mean, I presume that you could always have a non-zero one if you're willing to have very small ones, for example, in the mix. there's no reason that you couldn't have some amount, but I think you couldn't optimize the amount because you couldn't optimize the amount of currency in the system if it's tied too closely to something like gold. But I think I have to think it through, but I think it would be a little bit more in the realm of when we had discussions about like city-based basic incomes or other kinds of basic incomes in systems where there's a strong constraint on the amount of money that you can use, independent of productive capacity. There's like a separate constraint on it. And how would you do that? So I think you'd be kind of maybe more in that realm where you'd have to think about, where you're going to get the money from. Are you going to like tax certain people and like use it for the basic income, and how much can you give, and what's it trading off against? I think all those kinds of questions will come up. So it would be more constrained, but I think it would still be possible to have a small one, or at least a small one.
Yeah, I think that's probably right. There's no reason why you can't have a non-zero basic income. So the question is, could you really get it to the optimal level? And then, a question we could ask is, if you even without considering basic income, can gold really be an optimal basis for our money? So the reason why we choose gold, we're not choosing to have to keep our currency stable relative to gold and stable relative to consumer goods. The reason we chose gold as our basis in the first place is because it provides a standard that's already at least reasonably stable with respect to consumer goods. So maybe if you don't have a central bank, like the United States didn't have a central bank until 1913, but we had a gold standard starting in 1879 and a bimetallic standard, starting in 1792 or whenever. So if you have this kind of straightforward, we just keep the currency stable with respect to this one kind of underlying commodity, then you don't really have to worry about monetary policy as much. Or to be more accurate, you could say that a lot of it is automatic. You have to maintain your reserves of gold at a sufficient level. And if there's inflation, then the prices in your country go up. So people start importing things from other countries. And then that causes your reserve of gold to drain away. Yeah, go ahead, Bethany.
Oh, I guess you're starting to get at it, but I was wondering kind of what keeps the gold stable relative to consumer prices. I mean, because you mentioned that if you're kind of relying on that instead of doing it directly, I'm curious what would keep it stable?
Yeah, so I mean, the most fundamental thing is that there's a lot of different commodities out there. Gold is something that's generally widely valued. So different commodities have different degrees of stability with respect to consumer goods. So we picked one that was on the more stable end compared to consumer goods. So you can look at it either way. What are like the physical properties that make gold kind of a fairly stable priced commodity? And then you can ask the question, well, why did we choose gold in particular? And it's because whatever the most stable priced or whatever the fairly highly stable commodity is, that's kind of the thing we would choose as money. But then there's also this kind of network effect where if one country is choosing gold, then that's an incentive for other countries to choose gold as well. So a lot of countries were on kind of a bimetallic standard until the 19th century, and then kind of England switched entirely onto gold. It was partly Isaac Newton's fault in the 18th century because what happens in, so I'll talk about bimetallism in a second, but I guess you're not going to ask your question, so I'll talk about bimetallism now. So it used to be when the United States first formed that there was a specific amount of silver and a specific amount of gold that corresponded to $1. And they set these ratios based on what the market prices were at the time. And that was in 1792. But then a few years later, when the mint was actually capable of minting the coins, the relative prices in the market of gold and silver ended up being uneven. And it ended up being the case that that gold was undervalued and silver was overvalued. So people sent all their silver to the mint and nobody sent any of their gold to the mint. So we were kind of on a de facto silver standard for the first, I guess, almost 40 years of the United States. And then there was some legislation in 1834 that changed that ratio. And now it still wasn't in line with the market ratio, but it flipped in the other direction. So now the silver was undervalued and the gold was overvalued. So everybody sent their gold to the mint, and then we were on a de facto gold standard. And England used to have a similar issue. The pound sterling, and this was even further back. The pound sterling was originally a pound of silver, right? That's where it gets its name, the pound, right? It was a pound of sterling silver, and then over time, it wasn't a pound anymore. They kept shrinking the amount of silver that corresponded to the pound currency, and then in the 1719 or something like that. Isaac Newton, who was in charge of the mint at the time, decided to do the exact same thing. He said, oh, we're also going to have this gold coin. They previously had a gold coin that kind of floated relative to the rest of their currency, but he decided to fix the ratio. And then that kind of put them on a de facto gold standard because the gold was undervalued at that point. So you've kind of, it's difficult to standardize across multiple things, but so we never really had a true global gold standard, like gold standard, until like the 1870s, and it lasted about 50 years. So before that, there were certainly gold was being used, other precious metals were being used, other kinds of things were being used as money. But we really came into a global gold standard when it was kind of necessary for international trade, and everyone kind of coordinated on the same thing. Yeah, go ahead, Eddie.
Yeah, I wanted to point out in relation to Bethany's question that gold, because it's been valued throughout human history, and it's been mined throughout human history. At this point in time, it has, and in recent times, it has a very stable, total quantity above ground. Like the amount that is mined of gold per year is about 1.5% of the total amount in the world, and it gets doesn't get destroyed when people use it. It just kind of sits around as jewelry, or people collect it and then it circulates, but it maintains a fixed quantity, and so the price. So you end up with a relatively kind of stable supply. On the other hand, if you think about it, the economy, the real economy, is actually, post-industrial revolution is growing. And so you would think theoretically that with a growing amount of production and a fixed amount of gold, if you're on the gold standard, that you would get some deflation over long periods of time. That, if you have to run the economy on the same amount of gold, but the economy is producing more and more, then your prices would have to come down to allow that to happen. And we do actually see that. History, like life, is a little bit messy, but for instance, with the standard gold standard period from 1870 to 1914, over the whole period you have some deflation. You have other periods before the Civil War that you have deflation, and you do generally tend to see some deflation over long periods of time on the gold standard.
Yeah, I think that's right. You can ask the question, even under a gold standard, what kinds of things are people keeping what instruments are people using for their savings? So are they actually kind of hoarding gold bars and accumulating them? Or are they accumulating, debt instruments that pay a certain yield or something like that? And I think even in the gold standard times, the answer was the second one. So the gold would be freed up to kind of continue this cycle of, people wouldn't just sit on it, they'd accumulate something else. So gold kind of acted as kind of the base money, but it flowed a little bit, and you didn't end up in a situation where I don't think you really ended up in a situation where you were mining gold and then people just saved the gold and you had to kind of keep mining more gold in order to keep the economy going without economic growth. I think Eddie's point makes sense, which is that if you have a fixed size economy, then the fixed amount of gold can maybe serve that economy because it only facilitates, the flow of money and the base money and that kind of thing. It doesn't need to keep growing. Whereas the total amount of money and the total amount of savings needs to keep growing because the money has to go somewhere. Yeah, go ahead, Eddie.
Oh, to make the picture even more interesting, something I learned recently from Ray Dalio, and it's something that I'm not an expert on personally, but according to Dalio, apparently, if you look at the monetary history of imperial China, dynastic China, going back, hundreds and hundreds of years, they actually go through a cycle where they go from using the silver directly as money, and then eventually, you have things like sometimes you'll put silver in the warehouse, and then you'll get a receipt slip, an official receipt slip in the warehouse. And then that evolves further where you start to get something that's similar to fractional banking, and you have the slips, which are backed by silver, and you can exchange them for silver, but it's not necessarily there's not necessarily, it's not 100% backing. So you might have, $1 billion worth of silver, but you have, $100 billion or $10 billion worth of paper. Then it evolves to a complete paper standard where it's not backed by the silver at all. And then, eventually they have problems with that, and they go back to the metal itself. And so I think there are kind of pros and cons to each thing. And it's kind of interesting that according to Dalio, there's, you could see multiple cycles going through this progression in history.
Yeah, I think this is an important point, and maybe I just kind of assume everyone's already thinking about this. But it's always true that most of the money that people use is not the base money. It's usually little IOU slips that are IOUs for some higher form of money. So when we used gold as our standard, most people were not passing around gold to make payments. They were passing around, they had bank deposits, they were writing checks, they were passing around paper money and, subordinate coins and that kind of stuff. Gold was everything was ultimately kind of redeemable in gold, but that didn't mean that we were actually using gold in our day-to-day transactions. And I think that's the same thing you're talking about with ancient China, that it wasn't that, or maybe in some instances they were passing around silver coins, but in a lot of instances they were passing around these slips of paper for the silver that was in a warehouse. And the amount of silver in the warehouse doesn't have to exactly correspond to the amount of IOUs that are circulating for it. Go ahead, Bethany.
Yeah. So in terms of the point Eddie made about, the gold quantity staying about the same and the economy growing such that you would want more money or money circulating faster or something like that, isn't it the case that, or correct me if I'm wrong, that this ended up leading to like a couple of different things? One, I think we've mentioned some of them, but one would be like redenomination of the gold. Right. So like the gold, you said, or like with silver, a pound was one, pound of silver. Now, then it was less, then it was less, then it was less. And I think we did the same kind of thing with gold. A second would be like, even if technically the money is redeemable for the same amount of gold, you can circulate more and more and more on top of it, like basically more credit on top of the same amount of gold. And just like we do that now with like dollar reserves, they were doing that with gold. And so that would kind of expand. But as I think Eddie pointed out, you also had a bunch of collapses. So I'm wondering if those collapses were partly due to like the expansion of sort of credit on top of the gold, or if they were due to something else, sort of related to the issue of not being able to have the gold quantity itself expand. But maybe you can speak a little bit to where the collapses came from.
Yeah, I think that's exactly right. And it also has to do partly with if you've got this standard and you don't have to maintain the backing anymore. So say you don't you're not promising to that people can redeem their gold anymore. Now you have this kind of nebulous standard that's not tied to anything except what you promise it's worth. And then if you create too much of that, then or if you spend too much money into the economy, then it starts purchasing less and less and less, and then people don't want to use that as their monetary standard anymore. So that standard kind of collapses. It's there's also this problem with an overexpansion of debt and that collapsing. But I also think there's this bigger problem of there's just so much money circulating that you want to anchor it against something that has at least a somewhat stable value, even if it's not perfect. Yeah, go ahead, Bethany.
Yeah, that makes sense in terms of the initial appeal of gold. But I think Eddie was claiming that there was more economic instability on the gold standard than we've had since we left the gold standard. I don't know if other people agree that that's true, but if that is true, I guess that was the particular question I was speaking to. Like, why would that happen? And was it related to the fact that you can't expand the gold supply with the economy? And if so, like, what are the mechanics of how that would lead to like a crash?
Yeah, so it's not specifically about the size of the economy. It's not like the amount of money needs to grow in lockstep with the size of the economy, but it is true that the economy is going to need a variable flow of money in order for the money to remain stable. And it's also true that you don't want too much private credit building up in the economy because that can become unstable and collapse. So there's stability in terms of inflation and deflation, right? That's price stability. And then there's stability in terms of financial sector stability. So that's when you have too much buildup of private debt and then it collapses. And these two things can be very much independent of each other. It's not the case that inflation has to go along with an expansion of private credit, and it's not the case that deflation has to go along with the collapse of private credit, though the two can be related to each other sometimes. Go ahead, Eddie.
I think it's quite interesting to think about the fact that even if you have a fixed gold money supply, that if you have deflation and if you have the prices of goods in general going down, then that money supply, even though it's a fixed amount of gold, actually becomes worth more and more over time. And so it's actually a sort of market-controlled monetary expansion, which fits in a little bit with like what classic economists believed in with Say's law, where they believed that the whole thing was self-regulating, and that if there were, for instance, not enough demand in a certain period, like Keynes would later talk about, then suppliers would be motivated to lower their prices until there was enough demand. And if we're talking about gold as money, then at the same time that prices are going down, that's actually an increase in the real value of the monetary base. So I think that's very, very interesting. Yeah.
Yeah, I think one of the problems with that argument is that it very much depends on the distribution of the spending power. So if prices are going down as people are spending less and less, if you have deflation, you're not necessarily gonna. It's not necessarily the case that output will rise to where it was before, because the deflation could be, maybe there are some people who don't have any money at all. If the distribution of money is flat and the distribution of spending power is flat and everybody just starts spending less, then the economy will equilibrate back to where it was before. But if some people are getting a lot less and less and less money and then prices are going down, it doesn't necessarily bring the output back up to where it started. Does that make sense? Go ahead, Eddie.
Yeah, I agree with you on that completely, and I think that was one of the main things that I wanted to get into in this discussion, was that, like Alex said, if you imagined, like Keynes imagined, that everybody is kind of a similar agent, that everybody has a similar amount of money and they're just spending or not spending, then in that case, then Say's law would actually sort of work. And if everybody started spending less, then suppliers would just be forced to lower prices, which would, create enough money in the economy for it to run. But the problem is that in the real world, you have most of the population getting their money by selling their labor. They're consumer workers, and then small proportion are capitalists who are wealthy, and they spend all their money, most of their money. They live on a very little proportion of their money because they have so much, and they spend most of their money investing more. And so what ends up happening if you have a distribution where the consumer worker um, does not have enough money, is that you can get a crash. You can get an aggregate demand crash, because the consumer worker not being able to spend enough money actually reduces the demand for their labor. So it's a positive feedback loop. That causes them to have even less money to spend, which causes them to have even harder time finding work. And so I would argue that the Great Depression is an aggregate demand crash that occurs due to this, which I call the paradox of the worker consumer. Um, and it's actually not primarily a monetary phenomenon. Like if you just inject money into the system, but it doesn't go to the right place in the economy, it actually will not fix that problem. And I think that's where we are right now, that we're actually injecting enormous amounts of money into the wrong place in the economy, and it's having a great deal of trouble fixing the problem, which is why we get so much money in.
Yeah. So a question we can ask is under, under whatever conditions you happen to be operating under, what is necessary to keep prices stable? So what's necessary to keep prices stable under a gold standard? Maybe you need to have, in order to prevent deflation, because you're not mining gold fast enough, you need to have an expansion of credit that's really high, and you need to do it in a way that doesn't drain gold out of your economy into foreign countries. And I think that's part of the tension that arose during the gold standard as well, is that a lot of times you might have a monetary policy, this happened with the Bank of England, that kept prices stable domestically, but it caused gold to go to France or other countries because in the gold markets, your interest rates were not compatible with keeping the gold in your country. So you had to raise interest rates to attract the gold back, but then that shrunk your domestic economy. So there was kind of a tension there. So gold provided this stability on one level, but it also prevented the flexibility that's needed. And if you need to have an elastic money supply to maintain a stable price level, then you start to run into problems. And in today's economy, without a gold standard, you have some of the same issues, but you don't have to worry about running out of gold. You only have to worry about what your price level is, what your exchange rates are. So that kind of frees you up. Now you have the freedom to have an elastic money supply, which if you manage it properly, you can keep a stable price level and you can keep your economy going okay. That alone does not solve the problem of financial sector instability, which has to do with the mechanisms that we use to get money into the economy, kind of as you're getting at, Eddie. Depending on where we inject the money or through what mechanisms we inject the money into the economy, we might be able to prop prices up, but it doesn't keep output at the level we want, or it doesn't allow for the stability that we want in the financial sector, because we're forcing too much private credit to be created, that kind of thing. Go ahead, Eddie.
Oh, I do want to mention that, in the past, I've, kind of thought that, the Fed injecting money to some degree was responsible for this financial instability, but I no longer believe that. As we talked about in a previous week, the government is actually borrowing a large multiple of the amount of money that the Fed injects into the economy, into the debt markets. The government actually borrows an even greater amount back out of the debt markets. So actually, adding those two entities together, the government is theoretically should be causing interest rates to be higher than they would otherwise if the government were not doing this enormous amount of fiscal policy and borrowing so much money out of the debt market. And so I now believe that the financial instability comes directly from the capital consumption imbalance, and that if you don't have enough spending, that causes your factories, your equipment, your capital to become idle, your physical capital to become idle. And when that happens, then that reduces the profitability of investing, of doing real investment into that physical capital, which causes this enormous savings glut that doesn't have a productive outlet to be invested into real capital, and instead you get interest rates going down, you get capital running about and creating asset bubbles. And you see the same thing happening today, and you saw the same thing happening prior to the Great Depression with the enormous stock market bubble, going up to 1929.
So the question is, where does the capital consumption imbalance come from in the first place? And the answer is that the Fed has to keep interest rates low. So it's not that the Fed is injecting money directly into the economy per se. It's that the Fed is lowering the price of borrowing. It's allowing more businesses to borrow and invest in things that are not productive. And then you have you just have a lot more borrowing in the economy, and that creates the instability. Whereas if you had something like a basic income, that gives people money to spend directly, and you don't have as much private sector borrowing. Does that make sense?
So I would actually say that the capital consumption imbalance comes from the action of that positive feedback loop that we talked about earlier, the labor income, consumer spending positive feedback loop, where if you have the labor income stagnating, then that causes consumer spending to stagnate, which causes income to stagnate also. So that drives
Right,
kind
but
of a downwards track, right?
where does that positive feedback loop come from? And I'm saying that it comes from the you have consumer income being low, so we prop up prices by increasing the amount of lending and borrowing in the private financial sector, right?
I mean, I would actually, I mean, my current view is actually that the capital consumption cycle runs itself, that after you crash, you get economic reform, such as the New Deal last time, and then it starts rising. And so as it rises, it also is a positive feedback loop, and it goes
So
up and up and up until you hit
let's establish for
the
people what
limits
we're
of
talking about
productivity.
here with the capital consumption cycle. Like, what does that mean? So I think just to kind of quickly lay it out for people, the idea is that consumers have a certain amount of money to spend to buy the economy's output, and then businesses have a certain amount of investment in either productive capacity or in whatever they want to invest in, but they have more ability to invest in productive capacity than consumers have access to money to activate that capacity. So as you're increasing the amount of money that businesses can put into capacity development, and you're decreasing the amount of money that people can spend, it creates an imbalance. Is that kind of what you're getting at, Eddie?
Yeah, absolutely.
Yeah. So then the question, yeah, go ahead.
Right, absolutely. I mean it runs as a cycle. That what you described just then is the downward cycle of the downwards part of the cycle, where labor income is stagnating and causing consumer spending to stagnate. Then you get a crash, then you get economic reform, and then it goes upwards, also as a positive feedback cycle, until you hit the ceiling of productive capacity. And that's what happened in the 70s, where spending continued to rise, labor income continued to rise, but the productive capital in society was not sufficient to cause production to actually rise. So you end up with inflation, price inflation during that cycle. Then the politics swings back around, and they start. Prior to the 70s, you had the Great Society. You had everybody was very Keynesian, and everybody loved government spending after the Great Depression. You get to the 70s, you get inflation, and they go back the other way, and they start peeling off that government spending, and so then you get the downward cycle again. So it basically it kind of just bounces up and down between the lower limit, where people are there's so many people are having so much trouble financially that the government absolutely has to do something, and then it goes up until spending is too strong, and you hit the limits of productive capacity, which causes the politics to turn again.
So Eddie, there's a lot you said there that I disagree with, but I don't want to get into it all right now. So let's maybe we'll have a whole one of these on the capital consumption cycle at some point. But right now I want to get into a quote from the article. Here we go. In theory, the gold standard therefore limits government spending to only what it can raise in taxes or borrow against its gold reserve and prevents it from simply printing money to pay its debts. It also takes power over the money supply away from central bankers. Indeed, it might render central banks mostly unnecessary. Bear in mind that for the most of the classical gold standard era, the US didn't have a central bank, which was introduced in 1913. So I think this quote kind of speaks to the idea that gold is a form of money that doesn't necessarily have to be managed directly. So Bethany was talking earlier about how under a gold standard, well, you have to keep the currency stable with respect to gold, but then you also have to keep it stable with respect to the price of consumer goods. And I think what you're doing is you're just saying, you know what, gold is stable enough with respect to consumer goods. We're just gonna promise that you can redeem your money in terms of gold. Go ahead, Bethany.
Yeah, so two things. One, I still don't totally understand how gold stays stable with respect to consumer goods. Like, I understand that it maintains some value based partly on consensus, based partly on like the use that it has and so on. But I don't understand why that value is stable with respect to like bread and milk and whatever. And then the second point I wanted to make was that I thought that England did have a central bank, even if the United States didn't, with the gold standard much, much earlier. And that like it even emerged somewhat necessarily, like started out as a private bank kind of fulfilling that role and then became national. So that kind of speaks to the fact that the gold standard maybe didn't totally obviate the need for centralized banking. So maybe you can speak to that also.
Yeah, so England certainly did have a central bank much earlier, the Bank of England, and they did have a gold standard. It's important to keep in mind that the gold standard wasn't just a national standard. It was an international standard. So it was, France and England, all the European countries, and the United States eventually were all pegging their currency to gold. So this in essence created fixed exchange rates, or pretty close to fixed exchange rates across all the major international economies. And it was kind of this international standard. It facilitated international trade. So there was no central bank for that. In a sense, you could say that that England was kind of the top of the hierarchy, and they had most of the gold markets. So maybe in some sense the Bank of England was at the top of the gold standard, but not exactly. It was kind of this kind of independent standard. So even in the case of England, they were on a gold standard. They did have a central bank. There was not a central bank for the gold standard per se. And then the question is, how does gold stay stable with respect to consumer goods? And the answer is that it doesn't stay nearly as stable as you would want an ideal currency to stay. So it doesn't stay nearly as stable as the US dollar does today, for example. But it was kind of the best they could do. And we can talk about, what properties of gold allow it to be more stable than perhaps other alternatives. Like, why aren't you using, wheat as your standard currency or something like that? And we can talk about the seasonal fluctuations and the fact that it also degrades and is consumed and that kind of thing. So gold had some certain physical properties, and it was widely valued, and it wasn't perfect, but they had to pick something, and there was no kind of universal international standard other than gold. Go ahead, Bethany.
So can you remind me, just as a side note, what the Bank of England then kind of was focused on doing if it wasn't required to kind of keep the gold standard going?
Yeah, so certainly they were in charge of not running out of gold, so they had to do that. The other thing they needed to do was to maintain stability of the banking sector, the financial sector in England. So a lot of times you had, banks that needed to borrow, and we're going to run out of reserves on their own, that kind of thing. They would go to the Bank of England for help, that kind of thing. So the Bank of England helped smooth over financial volatility, and they used their gold reserves to do that. They might say, oh, well, we are going to allow some of our gold to flow out of the country in order to stabilize the financial sector, that kind of thing. So they're not actively trying to keep gold stable with respect to consumer goods. They're actively trying to keep their currency redeemable in gold, which they weren't able to do 100% of the time. Sometimes they had to suspend convertibility into gold and then go back on it, like times of war, stuff like that. So it wasn't a perfect system, but they were mainly focused on financial sector instability, and they were focused on keeping the pound convertible to gold at the required rate. Go ahead, Neil.
I just wanted to mention that I personally think that without the CARES Act, we would have had a lot of financial troubles, and I think without an additional stimulus, I don't understand why people think that without additional stimulus we will not end up in a trap where we will not go back into the depression type situation, since we're getting the opening salvo. People can credit card debt is suddenly going up. People are not able to spend as much, and if we do not have a lot of fiscal money put out, I do believe, and I don't understand why go on financial. All the bankers seem to think, oh no, we're going to just go up, but I just don't see it. I don't understand why people aren't as worried as I am that if we don't do nothing, we're in trouble.
Yeah, I mean, I think a lot of people are worried that if we do nothing, we're in trouble. I'm certainly one of them. I think there is, there is room for more expansion of private debt, but so even without the fiscal support, there's a lot more the Fed can do, and the Fed has been kind of doing more quantitative easing and that kind of stuff. I agree with you that the ideal is to have enough fiscal support, enough, they call it stimulus, but enough giving consumers enough access to the economy that the Fed doesn't have to go to so extremes with monetary policy. I don't think there's necessarily going to be a crash right away, but certainly if you're using the private financial sector to give the economy its money because the fiscal authority isn't doing enough, then yeah, you would expect over time stability to build up in the financial sector, just like it did in the lead up to 2008. Do you want to respond to that, Neil? I guess Neil is, I clicked on ask to unmute. Maybe he's not there anymore. Go ahead.
Without printing money, without printing money, I don't see how we get out of this problem. I don't understand why I get all these commentators like you saying that the Federal Reserve could do anything. They know they can't do anything. They're doing what they can do. But if you listen to all the governors, everybody more or less agrees with me. And unless you actually print money, the people who are on the bottom who are in trouble, they're just going to end up. Why are we killing people? They're going to end up abjectly poor. I just don't see why people think that everything is great because the stock market goes up. That has nothing to do with the. I have a lot of money because the stock market goes up, but that has nothing to do with that has only some relationship to the actual economy. And you would think that I don't know if there'll be a market crash when we have, but it may be. But I just worry. I really am very worried.
Yeah, so I guess there's two issues here. One is the potential for financial instability causing a market crash and we go into a recession, that kind of thing, or we're already in a recession, but maybe there's a financial crash and it all gets worse than it already is. So there's that concern, and then there's the concern of people being left behind and people just being screwed over and being forced into destitution, that kind of thing. The stuff the Fed is doing is largely not going to prevent the second thing. Maybe it will to some extent on the margins by causing more money to trickle out through the labor market or something like that. But a lot of people are going to be in a lot of trouble. And if we don't have the kind of fiscal support that you're talking about, then we're not going to prevent that. I completely agree with that. In terms of whether there's going to be a crash or whether we can just kind of keep going, I think it is possible for the Fed to keep things going for the most part. And you talk about printing money, and in of the fiscal authority, the government spending money into the economy is printing money. The Fed perpetually buying up financial assets that might not otherwise have enough market value or something like that, backstopping those markets. That's also kind of another way of printing money. They're swapping one kind of liability for a rock solid government liability, just money, right? So that's printing money in a sense, and that can kind of keep the financial sector stable. It can prevent deflation from occurring, that kind of thing. It might over time, as people are lending more and more and borrowing more and more in the private financial sector, unless the Fed just agrees to buy up all private sector debt, which is kind of the extreme of what they could do, right? Anytime you borrow, the Fed will buy whatever bonds you're issuing or something like that. Unless you go to that extreme, then keeping the financial sector overstimulated is going to eventually lead to more and more instability and maybe a crash like 2008. But I don't think it's something that necessarily has to happen right away. And if the Fed did decide to buy all private sector debt, you can, if you could always just borrow perpetually from the Fed, that would be almost equivalent to fiscal money printing, because now you're if you're just some guy walking down the street saying I need to borrow $100,000, and the Fed doesn't check to see whether that's a legitimate loan or something like that, and you can roll it over perpetually, that is functionally equivalent to printing money. But I don't think the Fed, they certainly don't want to go that far, and I don't think they're going to go that far. Yeah, go ahead, Neil.
I just wanted to say that basically what the Fed is doing, of course, one of the properties you end up with zombie companies. In other words, companies which are purely in existence because they can borrow money, which in the normal situation they would not be able to, and they would normally go out of business. That is but it's still, as I say, I don't know if you'll have financial instability. That doesn't really matter if people are if we can have a depression without financial instability. There's no reason why. Financial instability is what the Federal Reserve could stop. But if we don't do anything, I don't understand the Republicans' argument. I just don't understand it. I'm missing something.
Yeah, I think that's right. You can have a depression without financial instability, and you can have people being incredibly poor and suffering without even a depression, right? So all of these things can kind of happen without the other one. In terms of what the Republicans are arguing or what the politicians are kind of fighting over, I guess I don't have as much to say about that. I think, the right thing to do would be to have more fiscal stimulus or to have more fiscal spending to support people. Even, a basic income would be great, right? And then you don't have to weigh the economy against, keeping people safe, that kind of thing. You don't need to create jobs. You don't need to keep people employed for the sake of the economy. You can only keep them employed to the extent that we actually, in our context, still need that labor or something like that. So I certainly think that the right thing to do is to provide more money directly to consumers right now and kind of always, but especially during the coronavirus crisis. Go ahead, Richard.
Well, America actually did have a central bank before the Fed. It was established by Alexander Hamilton in the 1790s before it was abolished in the 1830s by Andrew Jackson. And there actually was an economy based on wheat and on a grain, rice in Japan, and from the feudal period, during the feudal period until that crashed with and the emperor became the head of the government. And then the way I see it, gold isn't actually that stable in the future. There's a single asteroid that could be mined that has $10 quadrillion worth of gold and platinum and things. So that's more than several times the entire world economy. So that could crash the economy easily.
Yeah, the stability of gold depends largely on the stability of mining. If suddenly you're able to mine a lot more gold, that's not going to allow the gold standard to remain very much stable for very much longer. So it really kind of depends on this thing that's somewhat variable. And we've had gold rushes at various periods of time that have caused inflation, or maybe you know devalued the value of gold in certain markets or something like that. So gold is certainly not perfect, and there's a reason why we're not on the gold standard anymore. So one of the questions I asked at the beginning was, what's the reason why we went on the gold standard in the first place, and then what's the reason why we're not there anymore? And I think part of the reason why we're not there anymore is that our institutions grew up. We were able to make stable promises about the stability of money that were not dependent on gold, and that were more stable than you could possibly ever achieve by relying on gold. But as our kind of economy was starting to globalize, everybody needed a standard to kind of hang their hat on and trade in terms of. So I think that explains kind of why we went onto the gold standard in the first place, and then also why we went off it later. Go ahead, Eddie.
I wanted to point out that due to consumption not being able to keep capital busy and resulting in a savings glut or a capital glut, that the asset bubbles and the huge stock market prices are to be expected. Like that actually makes sense that would happen at the same time that the real economy is, in a sense, going down and beginning to crash. The other thing that I wanted to say was that I think the gold bugs and most of them follow the kind of the Austrian line of thinking. I think that they are onto something in that the mainstream economic economic theory and the mainstream's economic system, there's something missing there, where it wasn't designed to go where the interest rates go down all the way to zero and then you just start printing and you never stop. Like it's there's and at the same time you have the government deficits which get larger every year. It was 1 trillion last year, and it's I haven't even I don't have it off the top of my head, but I think it's like a few trillion this year as the economy's gone down. There's something that is really unsustainable about this theory and this system. And I think that the Austrians, I don't think they're right, but I think they're picking up on that in the same way that the MMT theorists also pick up that there's something kind of missing here that needs to be explained, that mainstream economics doesn't. And I would say that go so far as to say that Keynes was actually wrong about the cause of the Great Depression. He was subtly wrong. He was right about it being aggregate demand, but he was wrong about the cause of that. Yeah.
Yeah, I think money is one of these kind of hotly debated things, and a lot of economists don't even like to talk about money, right? They like to talk about goods for goods, and then money is kind of a veil, and it facilitates the trade. But underneath all of that facilitation is really just a system of goods trading for other goods and all relative prices and stuff like that. And I think in order to understand some of the problems that we have in our economy, you actually need to look at what money is doing, because it's really kind of it's it's something that people are actively trading with each other, and it matters that they're trading money and that all the prices are set in terms of this one thing, and that this is the thing that people are using as their means of payment. And then all of the superstructure of debt and credit that's built on top of whatever your base money happens to be, whether it's gold or something else, that's important too, because most of the payments people make are not, even under gold standard, most of the payments people make are not in gold. Most of the payments that people make today are not in cash, right? You're not paying dollar bills most of the time. You're transferring deposits at your bank by using your debit card or something like that, or maybe you're using a credit card, right? You're not actually spending the base money. So there's kind of lots of complexity there that affects how the economy actually works. And to kind of get back to something Bethany was talking about before in terms of gold being stable with respect to consumer goods, in some sense, you by maintaining a gold standard, if you're the Bank of England, you are deciding that gold is stable enough with respect to consumer goods. If you try to go a step further and use monetary policy to make gold even more stable than it already is, you're probably going to fail, because then you're going to cause gold flows to go to other countries that are trying to maintain this fixed price of gold, that kind of thing. So you're really you obviously chose gold because it's stable, and because it's reasonably stable, and because it's what everyone else is using, but you're not able to necessarily do the same thing that central banks can do today, which is to really have a consumer price level standard, so targeting the average price of consumer goods, because you really can't keep the prices of both of these things stable relative to money in the market. You have to kind of choose one or the other. And that's kind of for the same reason when I was talking about bimetallism before, you can't keep the price of silver stable with respect to the price of gold, right? Because then you're trying to keep two real things that are traded in the market that have market prices that are kind of largely outside of your control, stable relative to each other. Whereas with a fiat money, you are in complete control, right? You can increase the amount of it, spend more of it into the economy. You can reduce the amount of lending in the private sector. You can do all of these things to kind of modulate it. You really have the levers there, and you can't control how much people value consumer goods, but you can control kind of the flow of money going towards whatever the economy can produce, that kind of thing. So let's go to another quote from the article. Oh, this is a good one. They're all good ones. Questions of money are always political, and often a zero-sum choice between which economic class will prosper and which will suffer. Inflation erodes the value of financial assets, hurting savers but helping borrowers. Deflation benefits those with wealth and punishes debtors. Eventually, the latter group, the masses whose standard of living relies on mortgages and other forms of debt, tends to win out. So here they're making a statement about the people who favor, or if you have deflation, then the people who depend on mortgages and other forms of debt tend to win out. So it's an interesting question, because I think a lot of times when people talk about inflation and deflation, they're just thinking of these kinds of effects. They're not thinking about, well, money needs to be a standard, and it needs to be stable, otherwise we wouldn't be using it in the first place. So I think these effects are important, but it's also important to not lose the forest for the trees, and remember that the reason why we chose our money as money is because it's stable, and too much inflation or deflation kind of undermines the standard of money. Go ahead, Eddie.
Lost my thought there. Yes, do you want to go to Bethany while I think about what I was going to say?
I think Bethany may have lost her thought as well.
Bethany, that's
okay.
fun.
Go ahead, Bethany.
Hey, the reason I took my hand down was only because my main point you kind of made, but it was just that there's kind of the zero-sum elements of it, but then there are the things that seem to benefit everybody, which is having a relatively stable currency. And you kind of made that point, but I think there are both like zero-sum and non-zero-sum elements of how you manage it, I guess.
I think to some extent, if you have a stable currency, that's better for everyone, right? And if you're not thinking about the importance of a stable currency just in terms of the function of money as a pricing standard, then it can start to look like there's this zero-sum stuff. Like, oh, maybe we want inflation; it'll benefit some people and hurt other people, or maybe we want deflation; it'll benefit these people and hurt other people, or something like that. But it's not a zero. It's not a zero-sum thing. Certainly, those benefits and costs are there, but I think there's also a cost to everyone if you go in either direction away from price stability. Go ahead, Eddie.
Right. So I think that the real world is kind of a little more nuanced and complex than a lot of economists model it as. And so, for instance, when you're talking about deflation and inflation, um, people change their behavior based on what is going on at the time in the system. Um, particularly, people who are wealthy and have a certain amount of financial savvy. But one of the things I think that happened, for instance, with deflation was that, at that time, one of the classes of people that were having a great deal of trouble was farmers who were, being pushed against productivity growth in the farming industry, and they were having a great deal of trouble, and they would take out mortgages on their farmland, and then they would end up with deflation causing their mortgages to rise in value year after year, and that would kind of screw them over. On the other hand, you switch the system around, and you turn it into inflation, mild inflation for the most part, after the Great Depression up until now, and I would argue that the people on the bottom are still getting screwed, or maybe that they get screwed and they end up on the bottom, because you have in effect where people's wages are nominal wages, unless they go to their boss every single year and say, hey, I need a raise, which is kind of a hard thing to do. If they're not brave enough to do that, the automatic thing that happens is that their wage becomes worth less and less as you have inflation. And so yeah, that's my point, is that there, as the system changes, the rules change and the participants evolve. Yeah. And so it's very interesting to compare, again, the Great Depression era, where you had, I would argue that you're having a aggregate demand crash due to the paradox of the worker consumer in the depression, in a deflationary framework. And currently we've turned that around, and we're no longer in a deflationary framework today, but we still have the paradox of the worker consumer, and we're still having the real economy crash, even as the Fed does everything it can, and begs the government to send some money out, or to spend some
Yeah.
money rather. Yeah.
Yeah, I mean, I think you bring up an important point about people's psychology. If inflation is low enough, then most of the people in the economy are behaving as if there's no inflation at all, and that includes workers not asking for raises necessarily, or they might be asking for raises, but they're not like quitting their jobs and storming out if they don't get a raise or something like that. They're kind of thinking of money as being worth what it's worth, and then the people who are taking inflation into account in their calculations are maybe getting some benefit out of that. But I also think it's true that if inflation if inflation is anticipated or expected, and everybody knows what it's going to be, and everyone's kind of factoring that in and adjusting their contracts based on that, then a steady amount of inflation can look a lot like no inflation at all. And the same thing with deflation. Like whatever assets you invest in, the interest rates on them are going to have inflation baked in, all of that. This is kind of like Fisher's law, right? Where if there's higher inflation, then that leads to higher interest rates on the contracts, right? The debt contracts. And then if there's lower inflation, that might lead to lower interest rates, that kind of thing. So I think there's an important distinction between the effects of inflation and deflation if it just kind of hits you, and versus if it's just that it's there. It's a normal part of the economy that you expect. Go ahead, Bethany.
Yeah, sorry, I'm Dirk. I just wanted to point out that you often bring up the point Eddie did about like not getting a raise, basically, or getting a pay cut due to inflation if you don't get a raise, as a reason that we might target inflation of a certain amount. Because you've argued that otherwise a company in trouble might have to lay off workers, which is more of a shock, but like an across the board sort of pay cut that people don't really notice is a lot easier to absorb. And likewise, an explicit pay cut is hard to do. So you mentioned that might be a feature rather than a bug, to avoid layoffs, basically, right?
Yeah, that's exactly right, and I think that's a big part of why we target low inflation instead of no inflation, right? Because we want to allow that wiggle room. If people are psychologically behaving as if there's no inflation, then they can get implicit pay cuts without, I guess people don't like to get nominal pay cuts. So what ends up happening is employers will let go of workers instead of just not giving them raises. Whereas inflation gives the business that's struggling a little bit maybe some leeway to keep their workers on and not give them a raise and just allow the implied pay cut that inflation causes. But I also think that in a basic income world where people's income is kind of understood to be coming from the basic income, then that gives a lot more flexibility on wages as well. So I would wonder if low and steady inflation is the right goal in a world where you do have basic income and you're not depending on consumers to be receiving their money in the capacity of workers in the labor market, that kind of thing. Go ahead, Bethany.
Sorry, I forgot to put my hand down.
Okay, go ahead, Eddie.
I think it's interesting that, during the Great Depression, with the deflationary framework that they had, businesses would actually have to keep on cutting people's wages as the real value of those wages went up. And one of the things that happened during the Great Depression is that with the economy going so badly and so many people suffering, a lot of the larger businessmen got together and they said, look, we're all going to make this agreement. We are not going to cut wage levels. But what ended up happening instead, they didn't cut the wage levels. They kept the promise, but they were also struggling to keep their business running smoothly. And so they stopped hiring instead of cutting the wage levels. And I think when you compare that to what is going on right now, I think in the last 20 years, economists are perpetually looking at the unemployment rate and saying, look how wonderful, the unemployment rate. And it was indeed quite low, historic lows really in the last 10, 20 years, other than, 2007. But, you're neglecting from the picture that, wages haven't risen since 1980. It's been 40 years, and the economy has grown by, I think it's about a factor of 5, and wages are still at the same level at the bottom as they were 40 years ago. And so I've been reading Jeff Crocker, which is very interesting, and he points out that you really have to look at labor income as a whole, and so I would say it really doesn't matter whether labor income is being pushed because of high unemployment or because of stagnant wages. They both do the same thing. You can have stagnant labor income or dropping labor income through either mechanism.
Yeah, I think that's true that you can have stagnant income through either mechanism. I do think there's an important difference just in terms of the volatility. Like if a lot of people lose their jobs, now you have specific people who have no income and then other people who maybe still have their income. Whereas that's kind of a different effect on the economy from everyone's incomes gradually going down. So certainly they're both bad, but I think one is more disruptive than the other. And the one that's more disruptive is when some people just lose their income altogether. And I think a lot of that was happening in the Great Depression, right? Like businesses stopped hiring. So if you lost your job, you couldn't get a new one. And then some of them started firing people and also going out of business, right? Some of the businesses went out of business. So a lot of people just, so it was very uneven, right? I think if you're going to have this problem with labor income going down or just consumer income going down, then it's maybe not as much of a problem if it happens more smoothly and more uniformly across everyone. But that's only in cases where you actually need people's incomes to go down. And I think during the Great Depression, we had the capacity to produce all the stuff that we were producing in the 1920s. And it was kind of a monetary thing that happened. We could have had incomes just as high if we'd had something like a basic income or something like that. A lot of people argue that leaving the gold standard is a big part of what got us out of the Great Depression. And you can look at all the different countries progressively leaving the gold standard over the early 1930s, and the ones that left the gold standard earlier tended to recover more quickly. And I think that's because when you're on the gold standard, kind of like how I was saying to Bethany before, you're locking yourself into this commitment. And when you're not on the gold standard anymore, you can make a different commitment. You can make a commitment that's maybe better for your economy, more elastic to what your economy needs. You can supply the economy with the money that it needs to remain stable. And another option, which Bethany also brought up, was devaluing the currency against gold. So maybe you keep the gold standard, but you now a dollar buys less gold than it used to buy, or maybe an ounce of gold is worth $50 instead of $30 or something like that. So that's an option. There are a few problems with that. One problem is that unless you want problems with exchange rates to emerge, all countries have to devalue by the same amount. So it's this international standard, right? And in order to keep things stable, if everybody kind of cut or doubled the price of gold, cut the value of their currency in half, then you can maintain the stability of the relative currencies, and everyone's still on a gold standard. But now you've freed up more elasticity to have more money circulating, that kind of thing. So a lot of people were proposing that back then, even as early as the 1920s, when we were coming back from World War I, when a lot of countries had suspended the gold standard. But it really requires coordination at the international level, and that wasn't going to happen. But even assuming that you could do that, and you just have these periodic devaluations, if you're doing that, every 10 years or, regularly, then do you really have a gold standard anymore? Or are you just perpetually devaluing your currency in such a way that the price of consumer goods is stable? So is that really kind of like just a fiat currency that's coming in the back door once you're perpetually devaluing against gold? So I think kind of the gold standard becomes untenable once you really want to have a better price stability and that kind of stuff. Go ahead, Bethany.
Yeah, just in answer to your point, I think the devil's advocate argument would be that you only devalue against gold under like exceptional circumstances. So you still have like the constraint most of the time, and then war happens or like an international crisis happens, and then you devalue it. So it's kind of like a hybrid model, I suppose. I'm not saying this is the model I favor, but I guess that would be the argument, that you would kind of like only do it as a last resort, as opposed to the normal kind of run a course of how you do your monetary policy.
Yeah, I think that's a fair point, and certainly countries did that with suspending gold convertibility during times of war, times of crisis. Like, oh, this is only a temporary thing, and then they'd go back on it. Only a temporary thing again, and then they'd go back on it. So the question is, could you achieve that with devaluing every once in a while? Hypothetically, if you could get all the international economies to coordinate, could you still get the benefits of the gold standard without having to kind of be equivalent to a fiat currency or something like that? Go ahead, Neil.
I just wish to point out that Soros made over $1 billion by betting that the British pound would have to devalue. Basically, you can, if you try and keep the price of your currency stable, and you're losing money to other countries, at some point you run out of gold. So you have to do something. And but there's a futures market. So Soros was able to bet in the futures market about the price of gold in the future, and so he made a fortune doing that. And people point out there's a loop there. He buys he bets against in the futures market, and the people now he has bought up the gold so that England has less of it, and so now they're in worse trouble. And then they try so it just keeps going. And so he could force them to devalue, and then he did, which is of course a big reason not to be on a gold standard.
Yeah, and this happened even in the context of not being on a gold standard. They weren't, rather than pegging to gold, they were trying to peg their currency to the other European currencies. They were trying to have this fixed exchange mechanism in all of Europe. If anyone's wondering, I mean, I guess England has now left the EU altogether, but if anyone's wondering why they never adopted the euro as their currency, it's basically George Soros's fault. In 1992, he shorted the British pound, and they were unable to maintain the fixed exchange rate, not with gold, but with the German mark. And then they kind of gave up on the fixed exchange rate mechanism with the rest of Europe. And there are other, maybe they could have gotten back onto it at a different rate or something like that. So there's certainly a lot of politics and everything in deciding not to adopt the euro. But that was a big event that happened, and they were kind of on track to do it until that happened. So it can be very difficult to fix exchange rates, and it can be very difficult to fix prices of things in general. And when you're on a gold standard, if you're fixing your currency to gold, that's enough of a challenge on its own that it's hard to be able to accomplish anything else with monetary policy. And you see this with countries today, even, a lot of countries peg their currency, they have currency boards and they peg to the dollar, and they can't really do their own domestic monetary policy because doing so will, if they wanted to expand their monetary policy domestically, that would cause dollars to flow out of their country, and then they'd lose their reserve of dollars, which is exactly the same kind of discipline that was imposed on countries under something like the gold standard. So you do still see these dynamics today. Let's go to another quote from the article. Today, with inflation unusually low and stable, the gold standard is a tougher sell than it once was. But as trust in American institutions wanes, there is renewed support for money backed by something tangible, not the say-so of the government. If inflation picks up once again, a solid base of gold standard evangelists is ready to take it mainstream. That a supporter of the gold standard may yet wind up on the Fed's Board of Governors is yet more evidence that the idea's prospects are shining brighter than they have in many years. So I think this is a common theme with gold standard supporters, is that they don't trust the government institutions to operate efficiently. So maybe they'll even concede that if the government institutions were doing everything perfectly right, they'd have a currency that's even more stable than gold ever could be, or something like that. They just don't believe that it's going to happen. So they feel, some of them just feel that gold is pure money for whatever reason, they have various reasons. But if they don't trust the institutions, then gold worked for a while, right? So why not go back to it and take the government out of the money system? Go ahead, Bethany.
We've talked about this in here before, but it's, I think, very similar sentiment to the people who really believe in Bitcoin or some kind of like cryptocurrency. The same ideal of taking the government out of what backs your money, and like what is it? Why am I forgetting the name of the main one? Bitcoin, sorry. Yeah, Bitcoin is kind of like gold, as we've talked about in here, in the sense that it's got like a limited quantity. So it itself can't like expand and contract as fluidly. But it was, and it's supposed to be independent of like a government. It's not just like a fiat currency. So I think, and I think maybe it makes sense if there is this sort of lack of trust rising, that you see both gold proponents of the gold standard and proponents of these kind of like cryptocurrency standards. They're both kind of attempts to get out of the government sort of being responsible for the money.
Yeah, I think that's right. And there's certainly under a gold standard, there's things that the governments have to do to manage the flows of gold, to be able to maintain that gold standard. And if you had a Bitcoin standard, similarly, you'd have to have government institutions that are managing the flow of Bitcoin and Bitcoin reserves in their central banks and stuff like that. But it's not the same thing as doing full-on monetary policy. It's making the specific commitment to peg to a specific thing. And this kind of gets to the issue that there's actually a couple different ways to do a gold standard. Kind of the conventional way we think about it is that the government itself holds a reserve of gold and promises convertibility. And if you come to the government with gold, you can, or with money, you can turn it into gold, that kind of thing. But then another way they can do it to keep the price of gold fixed is they can go into the markets themselves and just buy and sell to get the market price of gold where they want it to be. So maybe they're not directly standing there and saying, hey, you bring me the dollars, I'll give you the gold. They're intervening in the markets. And I think that's something that's more analogous to typical modern fiat monetary policy, where you're not trying to keep the price of gold stable in the market by participating in the market per se, but you're trying to keep the price of consumer goods stable by participating in the market. I think under a traditional gold standard where you actually have the reserve of gold, everything's more explicit. You show like, oh, we have this gold. We literally are sitting on it, and you can literally come to us and we'll give it to you, and people can see how much gold you have and stuff like that. The government is never sitting on piles of all the consumer goods that people can want and promising that, oh, if you come to us with $10,000, we'll give you one basket of consumer goods. We have it over here in our vault or something like that. They're going into the market and buying and selling, or they're actually they're not buying and selling individual consumer goods. They're kind of modulating and using levers to control the flow of money and to influence the flow of money in the economy, which in turn influences the prices of consumer goods. But are you pegging the price of one commodity, gold? Are you fixing your currency to the price of one commodity, or are you fixing it to a basket of consumer goods? And if that one commodity happens to be an international standard, and it happens to be reasonably stable with respect to consumer goods, then that can be kind of a shortcut or an easy way to get close enough to pegging to consumer goods, without actually having to measure the price of individual goods and services and that kind of thing. So let's go to one more quote from the article. Yeah. The gold standard's discipline came from the fact that the government had to be sure that it held the necessary volume of gold in reserve, in case anyone wanted to exchange dollars for a set amount of the shiny metal. If it printed more money than it held in gold reserves, the state risked hyperinflation, or causing a financial crisis by shattering faith in the solidity of its currency. So I don't know that, countries at various times did have to suspend payments because they decided that they weren't able to make good on those commitments for gold. And generally, hyperinflation did not result. They weren't generally risking hyperinflation. Maybe they were risking inflation, hyperinflation in the price of gold, because if the government isn't going to give you gold, then you can't get it at any price from the government. But there's still a market for gold, et cetera, et cetera. So I don't really think there's a hyperinflation issue there. It's just that you kind of become untethered to the gold basis at that point. Go ahead, Bethany.
This might be a detail, but we've talked before in this discussion about how they did often print much more money than the gold that they had. They had to maintain like some kind of ratio, I guess, but it seemed like it was a little bit more flexible than this quote is suggesting. Like it wasn't like there was a particular hard, clear limit on how much you could credit or you could have in the system, basically, is my understanding, like sort of floating on top of the gold.
Yeah, a lot of times they did set limits for themselves. So they just instituted rules that set hard limits, but they didn't really have to be a hard limit. And the hard limits that they set were not 1-to-1. It wasn't that there was 100% backing all the time. And under certain conditions, there were times when the Bank of England was only allowed to issue new notes if they had the gold to back it, that kind of thing. But then in that context, they'd already issued a bunch of notes without enough gold to back them. So there were still more notes out there than there was gold. And Richard is bringing up in the chat the greenbacks during the Civil War in the United States. So these were notes that had a certain gold value. They were still technically tied to the dollar, which was defined to be a certain amount of gold or silver even back then, and they were not directly even convertible into gold, but there was kind of a promise that they might be at some point, and they were eventually in 1879. But yeah, what was I saying? Oh yeah, you can have not only can the government issue more of its notes, more of its IOUs for gold than there is gold backing it, but the private sector can as well, right? Anytime anyone writes an IOU, that's kind of more money in the economy. Anytime there's any kind of lending or borrowing, that's more potential spending in the economy, and it's not strictly constrained by the amount of gold in the government's reserves. But there's, as I was saying, there's a limit to how far you can go. And a lot of times interest rates will both constrain the amount of lending in the private sector. So if interest rates are higher, people aren't going to borrow as much and people aren't going to lend as much. But if the interest rates are higher, that also brings more gold in for the government. And then it has the opposite effect. If interest rates are lower, the government starts losing gold, but then there might be more money creation in the private financial sector. So a lot of times having more gold meant having the amount of gold be growing meant having the amount of credit in the economy be shrinking. So the amount of base money would increase and the amount of kind of derivative money further down the hierarchy would decrease, and vice versa in the opposite direction. So let's see, let's go to one more here. Yeah. Gold standard adherents often extol the strength of currencies such as the pound and the dollar in the early 20th century. Modern central banking, they say, has knocked the stuffing out of these once mighty currencies. The fact that average hourly wages have mostly been adjusted to match the rise in inflation doesn't seem to factor into the equation. Where mainstream economists see constraint, gold bugs see discipline, a government that cannot spend beyond its means, and a hedge against corruption. So I mean, obviously, if you're not relying on institutions as much, that is a hedge against corruption, but you're paying a cost in that, your currency is not necessarily as stable as it could be. And I think a mistake that a lot of gold bugs tend to make, or a lot of kind of sound money people tend to make, is the idea that inflation over the long run is somehow a problem. It's not. It doesn't really matter what the prices of things were 50 years ago, 100 years ago, right? Money has to be stable in the short run in order for people to be able to set prices on a day-to-day basis and for supply to meet demand and stuff like that. Maybe there's some argument to be made that you want prices to be relatively stable in the medium term, so you can have longer term debt and stuff like that. But for the most part, it's not a problem if the purchasing power of the dollar just keeps going down and down over time. I like to say that money is the thing you spend, not the thing you save, right? If you want to save money, you will buy some kind of instrument that's expected to provide a positive real return over time. So you're gonna get a bond or something that provides positive interest, and whatever the inflation happens to be, you're gonna buy something that beats that, right? Money is the thing you use day to day. It's not what you hold on to. Go ahead, Bethany.
I was just going to bring back the distinction between predictable and unpredictable inflation or instability here, though, because like if you're trying to have some kind of long-term investment and you don't know what inflation is going to be, or if it's going to be deflation or inflation or whatever, that's very different in terms of trying to do any kind of long-term planning. If you know it's going to be roughly 2% a year, something like that, that's sort of a controlled inflation, which is a little bit different than an unstable currency, and that does allow you to plan more.
Yeah, I think that's an excellent point. If you have a general idea of what inflation is going to be over the long run, then that provides no problem for investment, for long run investment, long term investment. So this is actually an issue that some people bring up because right now, what the Fed does is they target inflation. So they try to keep inflation at 2%. If they miss that target, they don't try to like make up for it so that inflation is 2% over the long run. They just try to get 2% now based on where we are now. So there are some people who argue that instead of inflation targeting, we should have price level targeting. With an assumed increase in the price level of 2% over, the next 100 years or something, and whatever year you're on, what price level you're supposed to be at, and then that would be price level targeting. So if you ever overshoot the inflation, then you got to undershoot to come back down, et cetera. I would say that inflation targeting is probably better than price level targeting because price level targeting, well, it does make investments more predictable. It's less stable in the short run. And I would say that the short run is more important than the medium run because that's the day-to-day, setting prices, supply and demand, people being able to spend and know what a dollar is worth, that kind of thing. So I wouldn't want to, if inflation is too low for a little while, I wouldn't want it to be kind of too high for a little while to make up for it. I don't think that makes sense. So I definitely prefer inflation targeting over price level targeting. Go ahead, Neil.
You are mistaken. The Federal Reserve has recently come out with a policy which basically is a compromise between the two. And it's basically saying that if we run cold for a while, we promise to try and run hot for a little while when we can, so that people can more or less guess that the price inflation will be 2% over the long term. And so they have basically kind of have a compromise for this position. Their view is if people don't believe that 2% will be what's happening, then we'll get into either deflation or an inflationary spiral because what they believe will happen, they'll actually act like will happen.
Yeah, that's exactly right. They did change this in the last couple months. I think it's a mistake. I don't think it's the right way to go. But you're right that they are doing it in this new way now. Let's go to Eddie.
So I think it's very interesting that if you listen to kind of mainstream economic ideas, the idea is that if you run the economy hot enough, you will get inflation, and that would seem to be due to running into capacity constraints. And so it's very interesting that the Fed talks about this inflation target, and they never talk about the fact that capacity utilization in the economy is at 70%, which is as low it's been in 100 years. So it's very unlikely that you're going to get supply constrained inflation right now when you're only running at 70%. You're nowhere near the ceiling. And I think that it's important to understand that there are really two different types of inflationary mechanisms. So if you go into the 70s, then you do see that the capacity utilization there is up to 90%, and you're getting inflation as you're hitting capacity constraints. If you look at another episode, the hyperinflation of the Weimar era in Germany, it's a very different picture. They were also not operating at that time. They were actually having a kind of a bad economy, a cold economy that was too cold at the time. They were not having a super hot economy that was running into the capacity constraints. It was a different mechanism, and I would argue that is kind of a capital flight, loss of faith mechanism that occurs in the Weimar in the 20s. And I'd say that there is, that if there is any danger in the current economy of inflation, it doesn't come from capacity constraints. It comes from the risk of capital flight, which comes from accumulating, an enormous amount of treasuries. We have, $20-something trillion worth of treasures, and that those treasuries, Alex and I have a long-standing disagreement because if I understand correctly, Alex considers treasuries to be basically the same thing as money. But I would point out that the treasuries are different than money because um, you would never take $100 billion and invest it into money. Like I'm just gonna put my $100 billion in cash, and that's somehow gonna make money. But treasures actually, most people don't realize that the big money in treasures is not made through the interest rate that it pays. The big money in treasuries is made through the appreciation of the bond itself, as the interest rate changes. So if you go back the last 20 years from 2000 to now, interest rates went down from 6-7%, and now they're like 1% on long-term treasuries. And you got an enormous amount of appreciation. Investors made a great deal of money on that bond, appreciating as the market interest rate went down. And so, unfortunately, that does set up a certain amount of, a potential for a bubble effect, where you've gotten the interest rate all the way down to zero. It can't go down anymore. So there's really no return left to be had in holding those $20 trillion of treasuries, and there is a great deal of risk, because if you do have inflation, then those treasuries get, their value goes down a great deal.
Yeah, I think everything you said is basically right. I do say that treasuries are basically just a form of money. It's an instrument issued by the government that pays interest, or it has a yield on it. It might be sold at a discount. But as you say, it's true that the prices can go up and down, and people can make money by buying and selling them. It doesn't just uniformly appreciate over time, although some of them that's the expectation, right? You're going to get paid back face value at the end. But a lot of times they're not held to maturity, and people are making money selling them when they think that they're overvalued, or buying them when they think they're undervalued and stuff like that. So there's this whole market for them, where people buy and sell them, this capital market. Let's go to, well, we're getting to the end, so I want to get people's final thoughts, but I also want to bring the question of basic income back into the discussion, because we're talking about what the government is capable of doing under the gold standard, and what kinds of commitments they're able to make. And I think it's hard to make the commitment to keep prices stable with respect to consumer goods directly when you're pegging to gold directly. I think that's right. And I think it's also hard to get basic income to the level that you would need to get it to kind of activate your full economy under a gold standard, because you have to, anytime you implement a basic income, you'd have to do it in a way that also allows you to maintain your gold reserves. So that puts a constraint on what you can spend into the economy. So maybe that constraint looks like your basic income is smaller than it otherwise would be in a fiat currency system. Maybe also that constraint looks like your taxes are higher than they would be in a fiat currency system, because you have to pull some of the gold back out of the market and back into your reserves, that kind of thing. But maybe you're not paying the basic income in terms of gold. Maybe you're paying it out as bank deposits. There's still an issue there, where if there are too many bank deposits, then the banks will still have to have enough reserves to cover those deposits and stuff like that. So there still is this kind of constraint that binds with gold. And as we know, the supply of gold, or the amount of gold out there, is limited by mining. So it's not something that can grow and shrink with the economy. And I think Eddie pointed out early on that if you have a gold standard, that will tend to lead to deflation. And he pointed out that the economy is growing, but the amount of gold is not growing as fast. I wonder if it wouldn't lead to deflation even in the context of an economy that's not growing that much, just because the gold, it's not being replenished. It, maybe some of it is accumulating somewhere or something like that. So there's a lot to think about with the gold standard. I certainly think, if we talk about Judy Shelton, she's the potential Fed governor. Her plan is not even the market-based plan, where you go into the market and push around the price of gold to get it to where you want it. She wants, the government to actually sit there and offer gold coins to you if you bring in dollars, that kind of thing. I think that would be a step backward. I think there's a reason why we have the gold standard, and there's a reason why we moved on from it. So let's get people's final thoughts. Since Eddie was just talking, let's start with Neil and then go to Richard and then go to Bethany. Go ahead, Neil.
I have very little to say beyond about basic income. I think with a basic income, without a gold standard, it's obvious that to me you would make the economy better. But I wanted to point out that we issue our debt in U.S. dollars, and the bonds are unredeemable for U.S. dollars, and the Federal Reserve can print infinite amounts of U.S. dollars. So if somebody wanted to dump their money, the Federal Reserve buys them. Big deal. What happens? I don't see where anything happening bad. The Federal Reserve's balance sheet goes up gigantically, but that doesn't. As long as we don't have inflation, that doesn't matter. So I just wanted to point that out, but I have nothing better else to say.
Yeah, I think that's right. The size of the Fed's balance sheet doesn't really matter. Go ahead, Richard.
Well, like I said before, if you want to go back to the gold standard, you could just mine an asteroid. But that would make gold pretty much worthless then. So you can't win either way. But with a basic income, you have to have consider the net price rather than the gross. And so I think that's right. So if you could just take away some gold, I suppose, from a person who's like hoarding it or something. I don't know. But that doesn't. They could just stow their gold in a gold mine or something, or hide it underground in some sort of a bank vault or whatever, and then you don't know where it is. There's always ways to get around things.
Yeah, I think that's right. You can have an economy that's on a gold standard, and you can have a basic income while you're on a gold standard. You're just not going to get the optimal results, I think. Let's go to Bethany and then Eddie. Go ahead, Bethany.
Yeah, I think I'm in agreement with what we've been saying. I agree that gold standard has a lot of cons in terms of flexibility and expanding kind of the money supply. I think I had one question that I didn't get to ask. So we've been talking about two different kinds of there are two different kinds of limitations two of the limitations that have come up. One is keeping the price level stable with respect to consumer goods, and the other is kind of maximizing the output at whatever level you think is sustainable in your economy and want to maximize it at. And it seems like the gold standard gets in the way of both of those in kind of different ways, but I'd be curious if you kind of like summarize that a little bit.
Yeah, I think that's probably right. In terms of keeping the price level stable, you basically have to go with whatever gold is doing. You're kind of committing yourself to gold. And then in terms of getting the economy to maximum output, you really kind of need something like a basic income for that. You need like an even distribution of consumer spending power. So maybe you would you'd be able to do something like that under a gold standard, but maybe the taxes that you'd have to use would there's a maximum you could achieve that's higher than anything else you could achieve under the gold standard, but it might not be as high as what you could get with fiat money, where you have stable prices and you are not necessarily taxing things you don't need to tax, if that makes any sense. Let's go to Eddie. Go ahead, Eddie.
Well, there was one discussion we didn't get to very much regarding the Austrian economists and who are often gold bugs, and a lot of their consideration is that they believe that the Fed manipulations are artificial, and they think that when the Fed brings the interest rates down too low, that tricks businesses into what they call malinvestment. And I think that's very interesting to think about. Um, you know, I actually don't believe that the Fed is the reason for the low interest rates. I think the low interest rates are actually occurring naturally. But additionally, if you think about malinvestment, I think that malinvestment is a valid concept for a single business or factory. So if I go build a factory for X widgets and I'm like, I think I can sell these, and I do build capacity for 1,000 a month, and then nobody wants them. There's only people only want like 10 a month. Nobody wants them. That's malinvestment. I made a mistake with my market research there. But if you're having something going on in the entire economy, where every single factory, on average, and business in the whole economy could produce 30% more, but yet they're not. That isn't a very interesting situation, and I think the Austrians would consider that malinvestment. But if you think about it like a household, and you have all these factories and you're just not running the factory because you don't have enough paper slips to hand to people to claim the production, obviously the problem is not that you built the factory. The problem is that you built the factory, and now for some reason your economy is not allowing the factory to actually run and produce what you intended to produce. And if it's across the entire economy, it's not a product. It's not a problem with the market for your product. It's a problem with the entire general market and entire economy. Yeah, and your setup like that.
Yeah, I think you're right. I think malinvestment is a thing in the sense that you can have a misallocation of capacity development, but then there's also this issue of not activating the capacity that's there, or not activating the full potential of the economy, and that maybe has nothing to do with malinvestment. It just has to do with, well, consumers don't have enough money to buy everything the economy wants to produce for them. It's not that the economy is wanting to produce the wrong things or something like that, which is, I think, more how the Austrians would frame it. So this was a great discussion. I think we're kind of all in agreement here that gold standard is, as Keynes would say, a barbarous relic. I don't see us going back to that. It would be it's interesting to think about why and how there are so many people who still believe that gold is the truest, purest form of money. And I don't know if that's ever going to go away. There's probably always going to be people who are thinking about it in that way. So next week's topic is workers versus consumers. To what extent does it make sense for us to tie these two roles together in our economy? So that is next week's discussion.